So let's make sure we define what quadruple or triple witching is. This is where it happens 4 times a year, and it is when not only do options expire, right? Because options expire on the third Friday of every month, but it's also where index options expire and single stock futures expire and index futures expire. So all of these derivatives expire today. And it happens also in March, it happens in September, and it happens in December. And so what does that mean? Derivatives, if you think about them, like our option contracts, but also future contracts, are all agreements for the transaction of stocks, indexes, ETFs on a certain day. So today's the day where all of a sudden, all of these contracts that have been traded in other markets are now actually turning into transactions in this market. And so, yeah, it creates a lot of volatility because decisions that were made months ago are finally coming into fruition today. So you're seeing a lot of stuff that has nothing to do with the current market dynamics. It was all decisions made months ago happening today. So it kind of throws things off. It especially throws off volume. So if you're using volume, whether you're using volume itself as a standalone variable in your, for instance, validation process, or if you're using volume that has been put into indicators. And a lot of people don't even know when volume is thrown into indicators, but or considered part of the math equation that calculates the indicator. But some of those would be accumulation distribution type measurements, on balance volume, the shaken oscillator. All of those have a factor of volume in there. So on quadruple witching, even on the third Friday of every month when options expire, you get a big kind of tick up in volume that is not from the normal buying and selling process of the day. And that throws especially technical analysis traders off, especially beginning technical analysis traders who are trusting indicators wholeheartedly without knowing what goes into the calculation of that indicator. So they're making trade signals based on the shaken oscillator, but the shaken oscillator is going to be completely off keel, and because most shaken oscillators are based on 10 days and 3 days, it's going to be off keel for the next 2 trading weeks, right? 10 days. So that's something to keep into consideration.
I do have a quick question follow up to that, and that is because certain contracts expire today, like across all these different multi classes, are these owners of the contracts trying to exit those positions before they expire? Like, does that have a little bit to do with why there might be more volume than not?
Yeah. So in addition to the actual, the volume that we would see starting on Monday because of the actual expiration of the contracts, what you're seeing is a whole bunch of traders trying to go ahead and close out their positions before the actual expiration happens. Usually when you're so close to either the future or the option strike price, the traders want to be sure one way or another. They don't want to be surprised with a transaction happening after hours that they didn't price in. So they'd rather close their position manually and mechanically a day or two before expiration just to get it settled, right? It's better to settle it on your terms, especially if there's any sort of confusion. Like if you're pretty far out or in the money and you've already figured out what's going to happen, then you let it go. But if you're right at that threshold where you don't know if it's going to go one way or another, a lot of times traders will go ahead and close out that position. So that also accounts for that.